What is the central bank role in financial stability? Have you ever wondered how the financial system stays stable in a world full of uncertainties? The answer lies in the role of central banks. Central banks play a fundamental role in maintaining financial stability, which is essential for the proper functioning of capitalist markets and the broader economy. They perform several key functions that help keep the financial system running smoothly. First, central banks are the sole issuers of legal means of payment. They provide immediate liquidity in the financial system, ensuring that payments between banks and financial institutions settle definitively. This prevents disruptions in the flow of money that could lead to larger economic issues. Next, they maintain the payment system, which is the core infrastructure for financial transactions. Central banks oversee this system to prevent systemic risk, which is the danger that the failure of one institution could trigger widespread failures across others. By ensuring a robust payment system, they help avoid bottlenecks that could destabilize markets. In times of financial crisis, central banks act as lenders of last resort. They provide emergency liquidity to banks or financial institutions facing short-term difficulties. This support helps prevent panic and bank runs, stabilizing the financial system when private markets cannot provide enough liquidity. Central banks also implement monetary policy and oversee markets. They influence interest rates and credit conditions through operations in financial markets. Their ability to monitor financial stability ensures that monetary policy effectively supports sustainable growth and price stability in the economy. Since the global financial crisis of 2008, central banks have taken on a more active role. They often use unconventional tools like quantitative easing to stabilize economies. With governments sometimes hesitant to take strong fiscal actions, central banks have become the main stabilizing force in capitalist economies. Additionally, the rise of shadow banking has increased systemic risks. Central banks have had to adapt by extending their oversight to these less regulated sectors. This helps maintain overall financial stability in a rapidly changing environment. From the perspective of capitalism, central banks are essential institutions that uphold the stability of financial markets. Their role ensures that capitalist markets can function without disruptions caused by financial crises. This support is necessary for capital allocation, investment, and economic growth. In practical terms, central banks continuously monitor risks, regulate payment systems, provide liquidity support, and implement policies aimed at preventing financial crises. By doing so, they sustain confidence in capitalist markets and enable ongoing economic activity.